Let's talk about what's going on with Gamestop and actually learn some lessons that we could apply to finance licensing exams like the SIE Series 7, 65, or 66. Now, before we get started, just a quick 5-second promo. If you're looking for tutoring services on finance licensing exams, check out my company, Basic Wisdom. And if you're looking for a learning program for the SIE Series 7 or 63, look for Achievable. The links are in the description below. Go check it out. Now, back to Gamestop. For the uninformed, and for those of us who have been living under a rock, not paying attention to the stock market, there's something incredible happening in the market that we've really never seen before. Gamestop, and yes, this is the company that you've probably seen in a strip mall where you go buy video games. Gamestop, symbol GME, has risen from roughly $20 per share in market price in early January 2021 to a high price as of today, Wednesday, January 27th, at $380 per share. That's roughly a 1,800% return in less than a month. Incredible is not a good enough word to explain what's going on with this. Just to put this in perspective, a $100 investment in GME at $20 would have bought you about 5 shares. And that total $100 that you invested early in January would have turned into $1,900 today at its high. It really is difficult to explain how big of a return that is. But for perspective, the S&P 500, which tracks the market prices of 500 very large US-based companies, typically rises by around 10% on an annual basis. 10%. So basically, GameStop stock just made 180 years worth of S&P 500 returns in less than a month. Now, is this the first time anything like this has happened in the stock market? No, it's not. In any given year, you can find some stock that has performed equally, if not better, than what we're seeing currently with GameStop. Usually you'll find these in the penny stock market. And in case you don't know, penny stocks are unlisted stocks. That means that they do not trade on a national big exchange like the New York Stock Exchange or NASAA. So they're unlisted stocks that trade in the OTC markets below $5 per share. Relatively unknown or financially distressed companies typically make up the bulk of the penny stock market. And yeah, there's a lot of risk in this market, but with risk comes return potential. Let's look at 2 stocks from 2020 that actually had better returns than what we're currently seeing with GameStop. First, let's look at Vaxart. Vaxart is a pharmaceutical company that went from a low price of 30 cents per share on January 3rd, 2020 to a high price of $17.49 on July 14th, 2020. Now, if you were somehow lucky enough to buy at the absolute low price and then sell at the absolute high price, that would have been a 5,700% return. Another example is Novavax, another pharmaceutical type company, which went from a low price of $3.65 per share on January 13th, 2020 to a high price of $189.40 on August 10th, 2020. Buying at the low and selling at the high with Novavax would have resulted in a 5,089% return. Incredible. These are just 2 examples of stocks that had a better return back in 2020 than what we're currently seeing with GameStop. So why is everyone talking about GameStop? Why is it all over the news? While the incredible increase in their stock price is certainly newsworthy, it's not just the increase we're paying attention to. It's the reason for that increase that's really breaking news right now. Now, going back to Vaxart. Vaxart saw a high price in July of 2020, and at the time, there was a reason for that increase. It was because the U.S. government had just adopted their oral COVID vaccine to be a part of Operation Warp Speed. Not only was the company in line to receive a bunch of government funding, but this was also a signal that they might have a vaccine that the private markets might want in the future. This was huge news at the time and the main primary reason why we saw such an increase in their stock price. And actually, the same exact thing happened in Novavax as well. The important point that I'm trying to get across here is that there were legitimate fundamental reasons for a spike in both these stock prices. And when I say fundamental, I mean characteristics or information relating to the company's business. Fundamental analysis of any given stock usually involves inspecting things like product lines, sales, costs of doing business, debt levels, revenue growth, and even looking at the people running a company. And of course, there were some really good reasons that related to fundamental analysis that resulted in both those stock prices going up. Now, quickly, back to GameStop. Did GameStop have some kind of fundamental event that influenced their market price because of something going on with the company? Not really. There was one thing that occurred that we could point to. Now, in early January, it was announced that Ryan Cohen, who was a co-founder of the successful company Chewy, and also some other former executives from the same company, they joined GameStop's board of directors after gaining a large position in the company's stock. While it's always good news to add really smart, intelligent people with great business track records to your board of directors, given that the board of directors are basically responsible for the overall direction of a company, that in itself is some news that should influence the stock price. But things like this have happened in the past to other publicly traded companies, and we typically see a moderate increase in their stock price, maybe in one day. So while we might be able to attribute some of the increase in GameStop's market price to the addition of those board members, there's no way that we could say it's solely because of that reason. In fact, I would say it's a very, very small reason why we're seeing such an increase in the stock price. Now, beyond this event, were there any other company-specific things that occurred that we could attribute to its huge bull run here recently? No, not really. In fact, GameStop honestly seems like a below-average company at best, at least from a fundamental standpoint. The company has a ton of debt. In fact, they have twice as much long-term debt as they have equity, meaning that they owe twice as much money over a long-term period as the current net worth of the company. They currently are losing the equivalent of over $4,000 per employee on an annual basis. And yeah, their revenue looks good, but remember, revenue only measures sales. It doesn't factor in cost of goods sold, operating expenses, debt payments, or taxes, anything along those lines. The company doesn't even have a PE ratio, which is the price to earnings ratio, because the company doesn't have earnings. Earnings are another way of saying net profits. So basically, GameStop is making revenue, but the cost of running their business is so high that they're actually losing money. Now, could we attribute some, if not most, of those losses to COVID? I think you can make that argument, right? I mean, fewer people are going out to stores and buying things in stores, and a brick and mortar store like GameStop is going to hurt from something like that. But let's be honest with ourselves. Brick and mortar stores across the board have been losing a significant amount of market share to the digital marketplace. Although GameStop has been attempting to build an internet presence, the reality is their current business model is primarily focused on those in-store sales, and that's why they're hurting. Even before COVID, I mean, I don't know about you, but I haven't been to a GameStop in over a decade, and yeah, that's anecdotal, but it feels like to me like this is a business on the decline. I could be wrong. So bottom line, my analysis of GameStop is it's a decent company at best that's trying to modernize their business model in the midst of a pandemic that's currently destroying their profits. Does this sound like a company that should be seeing a 1,800% gain in its stock price in less than a month? Not by any historical means or measures. Doesn't make any sense. Now, GameStop's rise is all about market psychology. At the end of the day, there's really only one thing that drives stock prices, and that's demand. If market demand for a specific stock increases, so will its stock price, no matter how silly or foolish it might seem on the surface. Traditional Wall Street players, like the hedge funds Melvin Capital and Citron Research, had recently been waging a short sale war on GameStop. For good reason. In case you don't know, a hedge fund is like a mutual fund, but for really wealthy investors. It's basically a big account that's managed by seemingly smart managers with tons of experience and knowledge, and they take their wealthy investors' money and put it into the market, and typically they approach the market from a pretty aggressive standpoint. And a short sale is when an investor borrows a security, immediately sells that security, and then buys it back in the future. Let's see if we can put short sales in context so that you understand it a little bit better, especially if you're struggling with it right now. Let's assume a hypothetical hedge fund shorts GME stock in early January when it was roughly $20 a share. They would have to find a source to borrow a ton of shares from, sell those shares immediately at $20, and effectively bet on the company's market price falling dramatically. And if they were right, they could make a considerable profit. Let's say in a parallel universe somewhere else that GameStop stock, instead of going up, went down. In fact, let's say it went all the way down to $1 per share. To close out the short position, the hedge fund would have to buy those shares back and give those shares back to the broker or financial institution they originally borrowed their shares from, and that closes the position. Short selling is basically backwards investing, where you're selling first and buying back later, but at the end of the day, we always want to buy low, sell high. That's how we make money in finance. Let's keep going and assign some numbers to this example so that we can better understand the profit potential for a short sale. Let's assume our hypothetical hedge fund sold short 1 million shares originally at that $20 price. That would have resulted in $20 million in what we call sales proceeds. Buying back the stock at $1 per share would have resulted in $1 million being spent on that stock, or another way of saying, establishing $1 million cost basis. Once you have the cost basis and the sales proceeds of any given investment, you can figure out what the profit or loss is. And in this example, the hedge fund would have made $19 million on their investment. That's a huge return. Hedge funds have been performing trades like this for decades, and sometimes they make some pretty incredible returns on aggressive moves like this. But you and I know that's not what happened. So let's go ahead and wipe our hypothetical example, and let's actually talk about what actually happened to GameStop stock. Well, their stock price didn't fall. I'll quote Reddit on this. It blasted to the moon. It reached a high price of $380 per share as of today, and we can mostly thank Reddit for that push. If you haven't heard of Reddit, it's basically a big message board where people post articles and comment on those articles, etc. And r/Wall Street Bets is a subreddit within the same website that's dedicated to discussing stock market investments that are usually ultra aggressive and risky, and the general sentiment on Wall Street Bets was they were taking it pretty personal that these large hedge funds were betting heavily against GameStop. This entire trend started with a random Reddit user back in 2019, and it culminated in basically an entire internet movement filled with tweets and memes and even some comments from Elon Musk. Somehow, a seemingly organic online movement took off, and people across the internet began piling money into GME stock. And the higher the stock price has gone, the more excitement that's built around this stock. And of course, this resulted in the price absolutely skyrocketing from a low of around $20 per share earlier in January this month to $380 high today, January 27th. Now, let's go ahead and frame this to better understand how much, say, a hypothetical hedge fund could lose if they were short this stock. Let's again assume that our hypothetical hedge fund sold short 1 million shares at $20 per share. This again would result in $20 million of sales proceeds. Let's assume, unfortunately for the hypothetical hedge fund, that they bought back the stock to close their short position when it reached its high of $380 per share. This would have resulted in a $380 million cost basis. And let's go ahead and compare the two numbers together. Sales proceeds of $20 million, cost basis of $380 million. That's a $360 million loss from their original $20 million short position. And if that hedge fund continued to hold the stock and it continued to rise, that loss gets bigger and bigger and bigger. Now, with all that being said, let's take 5 lessons away from everything that's been happening related to GameStop. The first lesson for us, the dynamics of short selling. Selling short involves borrowing shares and selling those shares and hoping that the market price falls so that you can later buy it back at a lower price and make a profit. Of course, you can lose an incredible amount of money as the market goes up because, you have to buy that stock back in the future. The higher the market goes, the more losses you have in front of you, and that is unlimited loss potential. Bottom line, short selling is a very risky investment strategy. If a suitability-based question pops up on a finance licensing exam, short selling could actually be a part of that question. Be sure you know an action like this should only be recommended to your most sophisticated clients who hopefully know what they're doing and can fully understand the risk they're getting into. In fact, I'd go as far to say that making a recommendation of a short sale is probably going to be a wrong answer 99 times out of 100, but there could be a situation where recommending a short sale to the right type of investor could actually make sense. Lesson number 2, short squeezes. Now, just so you know, on most FINRA or NASAA exams, the term short squeeze is not going to show up on your exam, although it's technically possible. However, some things related to short squeezes and understanding the general dynamics that occur with a large short position, all that is potentially testable. A short squeeze occurs when a number of investors with short positions are effectively forced to buy back their stock. Short positions always have to take place in margin accounts, which are accounts that involve borrowing capital of some form. In the case of a short sale, investors are borrowing shares of stock that they must buy back and return in the future. When an investor holds a margin position, you better believe the brokerage firm holding their account will pay close attention to the gains and losses, in particular the losses of that account if they occur. Think about it this way. If I were to sell short GME stock, and I borrowed that stock from you, you might be concerned about the prospect of never getting that stock back from me. Now, of course, we have an agreement. I borrowed shares, I sold those shares, and I have to buy those shares back and give those shares back to you at some point in time in the future. But what if I run out of money? What if I go bankrupt? Well, that's a huge problem for you. In that case, you lent me shares that rose significantly in value, and I was unable to give you their shares back. These are the concerns of financial institutions and brokerage firms when they lend out securities to their customers. Whenever a brokerage firm is concerned about something like this possibly occurring, they are likely to institute a margin call. Margin calls typically require investors to do one of two things: either to deposit more cash in the account to prove that they can continue to withstand the losses they're seeing, or to close out their position. So these hedge funds that were shorting GameStop stock, they were assumptively losing millions, if not billions of dollars on the price rising, and the financial institutions lending them those shares, I assume, sent them a margin call. If those hedge funds don't have a bunch of money lying around that they can post to their account to show that they can withstand those losses, they would be forced to buy back the stock and close out that short position. And you might already be thinking this, but the repurchase of those shares introduces additional demand for that stock in the market. The additional demand added fuel to the fire, and we saw GME stock price skyrocket even further. This leads us to lesson number 3, which is short interest theory. Short interest is a measurement of the number of shares that are currently being sold short as compared to the shares outstanding. As of December 31st, 2020, 102% of GameStop's outstanding shares, or over 200% of their float, have been sold short. For purposes of FINRA or NASAA exams, you don't need to know the specifics about these numbers or how more shares can be sold short than there are actually outstanding shares. Don't worry about that. All you need to know is that is a crazy high short interest. And for context, let's go ahead and look up Apple's short interest. Look at that. Less than 1%. Obviously, there aren't many people betting against Apple at the moment, probably for good reason. The super high short interest on GameStop can be related to a theory, and that's the short interest theory. Short interest theory is considered a type of technical analysis theory which only focuses on the dynamics of the stock market and, generally speaking, ignores company fundamentals. The theory states that the higher the short interest on a stock, the more bullish an investor should be on that stock. And normally this is a pretty counterintuitive theory, right? Why would anyone be super bullish on an investment that has a large number of investors betting against it? Well, GameStop is the perfect example as to why. Eventually, all those short sellers will be forced to buy back their positions, which will introduce more demand to the market, resulting in a higher market price. And the repurchase of those shares can be accelerated due to a short squeeze if there's a massive increase of the stock price on its own. The same GameStop investors are already looking at other opportunities by seeking out companies with high short interest. And that's maybe why you've heard a little bit about Bed Bath & Beyond recently. All right, lesson number 4. The market is driven solely by demand. While investors traditionally seek out successful companies with growing revenue and good business models, we are quickly entering into a new era of investing. GameStop seems like a pretty bad investment through a traditional lens, but at the end of the day, does it really matter? No. If the market is overwhelmed by demand, stock prices will rise no matter what. No matter how much debt a company has, no matter how much money they're losing, no matter how bad the situation might look for the company. If there's more demand to buy the stock than the supply out there to sell the stock, then hey, stock price is going up. That's simple. And now to our last lesson. Lesson number 5. The stock market can be extremely volatile. Now, this isn't always the case. On any given day, the stock market is usually fairly flat and not so exciting. However, volatility, meaning wild swings in price, both upward and downward, this can happen at any given time. Just to prove this, let's jump into a made-up time machine and go back to January 1st, 2021. Did you have any idea that GameStop would be going through this? Of course, there are probably a small number of people, especially on Wall Street bets, that had suspicions or hopes that this would happen. But I can tell you, as someone that studies the market on an everyday basis, I had no idea this was right around the corner, and I would assume that's the case from the majority of Americans. The volatility we're seeing with GameStop is benefiting smaller investors, which is great in my opinion. Hedge funds historically have been making millions and millions of dollars for their wealthier investors, so this definitely is a win for the small investor. However, volatility usually works against not only the small investor, but most investors. There have been 2 big events in recent history where we've seen volatility levels go off the charts, and that was the Great Recession, caused primarily by the real estate market back in 2008, and in March 2020 when we saw the COVID stock market crash. In both instances, the stock market experienced incredible levels of market risk, which is the risk that an event or a circumstance drives the prices of, generally speaking, most things in the market downward. From October 2007 to March 2009, the S&P 500 lost almost half of its value due to the housing crisis. And from late February to March 2020, the S&P 500 lost nearly 34% of its value during the initial stages of COVID. Whether it's GameStop, the housing crisis, or COVID, these are events that seemingly came out of nowhere for the most part. Stock market volatility is something every investor with a position in the stock market must contend with and eventually embrace. That's why we consider it unethical for you as a financial representative to recommend significant investments in stocks to older investors or those looking to avoid risk. Additionally, that's why many investors and advisors utilize the rule of 100 when determining a portfolio's allocation. You take a person's age and subtract it from 100, and that'll tell you what percentage of their assets should be dedicated to the stock market. For example, a 20-year-old could put 80% of their portfolio into the stock market, and this would be considered suitable for an average person at that age. Now, honestly, a 20-year-old that has anything in investments probably has their entire portfolio in the stock market, and that's to be expected. Now, let's compare that to the average 70-year-old, which, using the rule of 100, should allocate somewhere around 30% of their portfolio to the stock market, with the other 70% of their investments going into safer investments like fixed income or cash. If you were 70 years old, retired, living on a fixed income from your retirement plans or Social Security, would you want to get caught up in this mess? While GameStop's stock price is skyrocketing and all their investors owning stock are feeling great right now, here's a reality check. Eventually, the excitement surrounding GameStop will subside and its price will come down considerably. And a large portion of current GameStop investors are going to lose a considerable amount of money when that occurs if they stay in the investment too long. And if you're older and don't have a ton of time to make up significant investment losses, you should stay far away from investments like GameStop. You might have all the FOMO in the world, but high levels of return are really only capable when you're embracing high levels of risk. And that's how the stock market works. All right, those are your 5 lessons that we could take away from everything going on with GameStop. Thanks so much for watching this video. This is definitely kind of a break away from what I normally do. I'm sure it feels a lot more informal than my normal videos, and I'm interested in your feedback. If you like this video and feel like it helped you connect some of these kind of more obscure ideas in the material to what's actually happening in the real world, I would love to make more videos like this. Please give me feedback. Whether you like it or you don't, whatever, leave a comment. You can go to my website, basicwisdom.net, and get my contact information through those means. Any of that stuff works. Also, as a reminder, my partners and I are offering Achievable, which is that learning program for the SIE Series 7, and we'll soon have a program for the Series 6 63. I have lots of examples in the reading materials for Achievable that relate to the real world just like this. And anytime I see that there's an opportunity to connect the difficult things that we have in the material to some more understandable things that are happening in the real world, I think that's a great opportunity to help people connect ideas. So if this is the way you learn, check out Achievable. Again, the links are below in the video description. Thanks so much for watching. I appreciate it, and I'll see you next time.